That Fed decision to cut interest rates by 1/4 percentage point was pretty well unanimous, except for Stephen Miran. That's U.S. President Donald Trump's latest appointment to the Fed. He held out for a 0.5 percentage point cut. Let's get more from Carl Tannenbaum, Executive VP and Chief Economist at Northern Trust and a former Senior VP at the Chicago Fed. Thank you very much indeed for joining us.
Good morning, Andy.
Do you read much into the fact that the new guy at the Fed, Mr. Trump's pick, wanted a bigger cut? Does that point to a more dovish Fed in the year ahead, for example?
It certainly wasn't a surprise that he dissented. Also, for those who took a look at the dot chart, you saw this little dot, lonely dot at the bottom of the distribution for this year. He essentially called for 3 50 basis point cuts before the end of 2025, but is very much on his own. And Andy, one of the things that I drew away from this is there has been some speculation that once the administration has, quote, a majority on the board of governors of people who have been appointed by the president, that they would leverage that to do a number of different things. What yesterday's decision shows is that there were 2 Trump appointees whose dots were kind of mixed in with everybody else. They're more, I wouldn't say institutionalized, but they certainly have a regard and a respect for the independence of the Fed. Both Governor Bowman and Governor Waller have said so. And so what I would offer to those listening is that we should certainly be concerned about central bank independence, but the road to a takeover by the White House of the Fed is steep and rocky.
Wow, that's interesting. So even if Mr. Trump gets his own pick as head of the Fed, he still will have trouble exerting massive influence?
I think that's true. Certainly the case that is being considered by the American courts with Governor Cook and the ability of the White House to dismiss her is one that's being closely watched. If the courts give the White House a lot of discretion over moving governors around, there's a choice that the administration could make to perhaps make more movements of that kind. Andy, what I wonder is whether the American markets and the foreign investors who come here are going to stand still for that, and whether or not, if the movement is too sharp, that the long end of our bond market might show some reaction that would be counterproductive to the administration's goals.
What leaps to mind here is that bond investors, foreign bond investors, refusing to buy American debt or are demanding more before they purchase it.
Correct. And of course, that makes the job of holding down our national interest costs that much harder. Plus, the president has said that he would like to see American mortgage rates lower, very different, as you know, from those in Canada. We can lock in a rate for 30 years. If we keep the long bond under control, that might stimulate that interest-sensitive component of our economy.
I guess the big question, one big question is how temporary will the impact of tariffs be on inflation? Citi, for example, telling us today they think it will be transitory.
Yeah, Andy, I'm sorry. It's a little too soon to bring Team Transitory back for a second ride. Many of the arguments that we're hearing, these are level changes that will, pass through after 12 months, and we shouldn't worry about them, were ones that we heard from the Fed and other supervisors in 2021 about the pandemic supply shocks. Unfortunately, those ended up spreading very quickly. There's a good chart of, the number of fraction of items in our consumer price index that were moving ahead quickly, and it started small and then it really spread. So I think we ought to be a little bit careful with that logic, also because tariffs are getting phased in and reaching consumers at a different pace. This is going to look in the data and feel to American consumers very much as if it's steadier rather than sudden. So we'll have to watch the psychology as well as the data related to the inflation picture.
You do think there will be another cut next month and again in December?
I do. I think the case that the chairman laid out, which is that we have risks to the business cycle and more specifically to our employment picture, are ones that we need to address. And while not dismissing the inflation risks, he noted that American interest rates are considerably above where we would consider the neutral rate to be. If you're truly concerned about risk to the business cycle, you'd want to get closer to that neutral. He phrased this kind of a risk management action, and I think there's a bit more risk management to be done.
And finally, you, among others, are concerned about the reliability of job data. I mean, and this is not a new concern. I think over the years they have been questioned. It's, I mean, an economy of 1/3 of a billion people, not easy to measure. But what broadly do you think is happening in the US labor market?
Yeah, and it's an international phenomenon. The folks in the UK have been struggling with their data collection on unemployment for a while, so they only release 3-month averages, which may be where we're heading here. Yeah. But, obviously the root causes are poor survey responses, plus which we have moving parts like Canada. We had a surge in immigration in 23. It came down a little bit last year, and now it's slowed to a crawl. That affects some of the calculus underneath the census data that feeds the employment and unemployment rates. So it's a moving target. I'm not sure that anybody could do a very good job with it, as I always urge. And we need to take a look at these numbers over time, not focus on a single observation. And that's why the Fed, I think, wants to get out in front of this a little bit, because we have had a series of observations that don't look quite as uplifting as they had earlier this year.
Carl, it's always great hearing from you. Thank you very much indeed. Carl
Very welcome,
Tannenbaum,
Andy.
Executive VP and Chief Economist at Northern Trust and a former Senior Vice President at the Chicago Fed.